Welcome, everybody. We are going to start off with the Emerging Professionals panel. We've got a conversation on getting deals done. So we've got a couple of experts here who are actively working on transactions, going to share some of their perspectives on the work that they do.
I'm Mike Stanley. I'm the Senior Vice President of Sales for Congruity HR. We are a PEO, so I'll be moderating the panel today.
Jon Jasinski. I'm a senior associate at Harter Secrest Emery. We are a firm based in upstate New York, particularly Buffalo and Rochester. I work right down the street here in Buffalo, and I'm in our corporate group doing primarily M&A transactions, often with PE involvement.
David Dinolfo. I'm a partner at the Bonadio Group. Bonadio, we're a top 50 national CPA firm. And I'm a partner on our corporate finance team, specializing in investment banking and transaction advisory. On the investment banking side, we're representing generally businesses that are $3 to $10 million of EBITDA, $10 to $100 million transaction value. And then on the transaction advisory side, we do all things, financial and tax due diligence, quality of earnings, structuring, all those types of things.
So, Jon, for the first question around understanding deal life cycle, regarding deal sourcing, when in a deal process will service providers typically get involved, and how does the time of your involvement differ on the buy side versus the sell side?
So deal involvement, the deal life cycle is an extended process. Every deal is different, but typically from start to finish, you're looking at a number of months up to a year, and there's going to be a number of service providers involved, including lawyers like me and bankers like Dave. For lawyers' involvement, first of all, it depends on the client relationship. So if you're on the buy side, very often there's an existing relationship where you may have a client who's done historical acquisitions or is initially looking to become acquisitive. And in that instance, we're involved, from day one. Sell side can vary a bit more because if you have somebody who's coming cold to a deal, may not have a specific counsel in mind, they may have already started the process and might be asking around, have engaged a banker, and then we get engaged later. Or we might be that initial call and maybe we're making the referral out to a banker. Either way, in the typical process, a lot of the initial portions of the deal are more on the financial side, right? Because particularly if it's a deal that's involving a bank, you're going to have some degree of financial due diligence that lawyers don't particularly need to be involved in at that stage. So we'll be more in the background. And then once you come to definitive LOI, that's when legal due diligence, legal negotiation of the purchase agreement comes into full gear. So, at that stage, we're acting as a closer.
Yeah, I'd just say, on the investment banking side, our goal is to be the source of your deals, right? So for the PE folks that are in the audience, right? Our goal is to be the ones presenting you with deals and getting things on your table to look at, good opportunities for businesses that are in the market. And as Jon said, on the financial diligence side, it's pretty similar with legal. We like to get in there earlier. The earlier, the better, right? And to the extent we can be involved in proposed structuring and valuation to help with LOI proposals, the better. And then, obviously once the LOI is executed, our team will come in to do, the financial diligence, quality of earnings, those types of things.
Yeah, and transactions are long processes. So think of it like a marathon with a relay, right? And so there's going to be multiple handings off of the baton, and especially I think, Dave, fair to say that the first pass, it's the bankers that are often taking point, and then once you get to that LOI stage, it's handing off the baton to the accounting team, to the lawyers to come in for close, and then post closing too. Especially if you're representing a seller, you're going to have somebody who now has a pot of money that they may never have had in their life. So on a service provider side, there's a baton pass to wealth management advisors, folks in that space to make sure that money doesn't go whoosh the first day after closing.
And how did deals typically come across your desk? Referrals, cold calls?
Yeah, for us, deals typically come to us through referrals, right? Specific to Bonadio, we have the benefit of being part of a large accounting firm with thousands of business owner clients, right? So for us, it's more natural, and internal partner referrals are really our biggest source of leads. But other than that, it's things like this and people in the room like this, right? Networking with other service providers, attorneys, accountants, wealth advisors, the ones that have that direct relationship with business owners. So typically that's our referral network and how it works.
Yeah, and it's the same for us. So, as a full service law firm, Harter Secrest represents businesses at all stages in their life cycle and in a variety of practices. So, there's going to be instances where, it's an environmental partner's buddy from the golf course who's selling. So that's going to be an internal referral source, or it could be a longstanding client that's a referral source. But a lot of what we get is going to come from, other professionals in the community. When you've got somebody either buy or sell side who's saying, hey, I want to do a deal. How do I do this? Who do I need to engage? So that can happen. And you do get the occasional cold call. I mean, we have all sorts of fancy lawyer rankings that have varying degrees of quality to them. But we have gotten calls from folks that said, hey, I'm looking to do a deal in upstate New York. I saw you listed in Chambers. I want to engage you. A variety of ways, but referrals are definitely the primary source.
Very cool. And from my perspective, so Congruity is a private equity-backed, mid-sized national PEO. So RFE Capital is our owner, and we hold a buy-side advisor looking to source deals that are in our wheelhouse. Also, our senior executives are 30-year veterans in our space. So our CEO, if anyone's heard of it, was the founder of Oasis Outsourcing, which was started in 1996 and grew to be the largest privately held PEO, went through 7 transactions and sold to Paychex in 2018. So just with his industry experience and connections, lot of mutual referrals through the industry as well. From a due diligence perspective, what are the most critical aspects of legal or financial due diligence that emerging professionals should focus on? And do you have any examples of pitfalls they should avoid? And I'll pose that to David first.
Yeah, so on the financial side, right, structuring is a big thing, right? So from a business owner or a seller's perspective, right, understanding how the proposed structure on a deal impacts them is super important. A lot of times that can potentially get overlooked, right? Whether you're selling stock or whether you're selling assets, it's not just the top line number, it's the after tax number. So really understanding the different tax consequences when it comes to structuring between an asset or a stock deal. More so on the financial side, right? Like just making sure you're looking at the right historical periods, right? We talk to a lot of folks that are already in the 11th hour, and pick today, for example, right? We're in September, and maybe the freshest financial information they have for the company is through the end of 23, right? So making sure you get updated monthly financials, trailing 12 months, right? Like you want to make sure you have the most up-to-date, accurate information as possible.
And on the legal side, so in every purchase agreement, there's a section of the agreement which is about 30, 40 pages of stuff that, is great reading material if you have insomnia. And it's statements that a company is making about itself. And, the section's called representations and warranties. In 99% of deals, there's a subset of those representations and warranties that are called the fundamental representations. And they're fundamental because those are representations that need to be made in order for the deal to happen. So talking about what's most important for diligence, it's making sure that those fundamental representations and warranties are true. And it's basic stuff. It's like saying, seller, you're selling shareholders in the case of a stock deal. You guys own the stock that you purport to own, because if you don't own it, there's a problem. Same thing when it comes to authorizations and consents to do the deal. I do a lot of transactions in the financial services space. You're selling a broker dealer, you need to get FINRA approval. If FINRA approval doesn't come, practically you can't close a deal. There are some nuances to that, but in general, you can't close the deal. So making sure that you have an understanding of the fundamental reps and warranties and the information to backstop them is point one. Point two is when lawyers get that baton pass to run with the process, at that point, you already have an LOI. You already have a base purchase agreement. A lot of what you're doing is negotiating and allocating risk between the parties, because as you all know, every business has warts on it. Every ongoing business has something going on. There's going to be a question of how you allocate this stuff between the parties. And a lot of what legal due diligence focuses on is where are there potential pressure points where there's going to be a loss. So common things we'll want to pay more attention to is ongoing litigation. There's litigation, who's going to be responsible for it? It's reviewing contracts. If you're in a position where you're buying a company that has a few primary customers, what do their contracts say? I was working on a deal once where there was a company being sold that had one primary customer. That customer had a right of first refusal in its contract and it refused to waive it. So the customer ended up buying. So identifying those things is, critically important for diligence. And it varies by across industry, across deals. So having knowledge of how different industries work, is going to obviously buttress that. But the general point is, identify things that potentially create a loss and allocate it between the parties.
Yeah, I'd say just from a common pitfall perspective, I'd say the number one thing is delays, right? We say, time kills all deals, right? The longer things take, the more opportunities there are for things to fall apart. So, once you're in the process, right, making sure both parties are communicating and organized and have the right advisors to keep the process moving is super crucial. Because again, the longer things wait, the more opportunity there is for something to come up. We had a transaction we worked on a couple of years ago where, there were arguments about, is the founder's country club dues going to continue, like little nickel and dime stuff here and there, and it delayed the process. And then boom, all of a sudden, 3 of his biggest customers came to him and said, they're asking for price concessions that are going to significantly impact go forward revenue and margins, and the buyer walked away, right? So time kills all deals. It's a super important thing to keep in mind as people are going through the process.
That's exactly right. I mean, it's a marathon. There's lots of people involved. You want to, be able to walk the balance between time-killing deals and rushing to agree things that, you may not want to agree to. And a lot of that's why, you want to make sure that you've got bankers, accountants, lawyers involved who do this stuff, because then they'll be able to set the right cadence as to, all right, is this really something we need to be arguing over? Or, maybe this is the hill to die on.
Excellent insight. In our PEO space, one of the things that is very important and value too is the performance of the master medical book. So PEOs provide a master health insurance policy to all their client companies, and a lot of times it's very difficult to get insight into how that medical book is performing, which could drastically change the value of the organization. So something to think about in our space is looking into and finding as much data as you possibly can in that book performance. Next question I will pose to Jon. Actually, I'll pose it to David first. From a valuation technique perspective, discuss the importance of a quality of earnings analysis and how it can backstop an initial valuation.
Yeah, the quality of earnings is a very useful tool and really important in the middle market, right? Because most middle market transactions transact at a multiple of EBITDA. And that's the whole point of a quality of earnings is to validate what that EBITDA is. So from a business owner or a seller's perspective, a great idea to do a sell side QV on the front end before you start talking to potential buyers, right? To get that EBITDA validated by a third party and put that in front of buyers so they can see it, and that allows for higher valuations and more conviction from a buyer's perspective when they're submitting a proposal. And then on the back end, from a buyer's perspective, doing a buy-side QV, same type of goal, right? I mean, most times their offer is going to be based on a multiple of that EBITDA. So having a quality of earnings to come in and validate that is important because usually, the results of that QV could potentially impact the valuation and result in some sort of retrading of the deal.
Jon, discuss the importance of negotiation of risk allocation through reps and warranties, escrows, indemnification in a purchase agreement, and how can it support realizing value in a transaction?
Yeah, so to the point I made earlier, you get to an LOI stage, there's a dollar amount. For an ongoing business, there's always going to be potential risk. There's always going to be items that are losses that, may relate to an issue that happened pre-LOI, but the actual losses are realized post-LOI. So, I can think of a few examples where, the negotiation at this stage has had a significant impact on valuation. One, we were representing a seller that had selling properties that had significant asbestos remediation issues, which are costly issues. And this was something that the buyers were well aware of, and all the parties were aware of, and the cost would significantly impact value. But the buyers didn't ask for indemnification for it. They didn't ask for the sellers to be responsible, which shocked us. But that obviously was to our client's benefit, and as a result, the buyer was responsible for the asbestos remediation of the business they acquired. Flip side, buy side on a deal, our client was buying a yard care landscaping business in Florida, and that company had an employee who was struck by lightning and killed probably a year and a half prior to the transaction. So obviously, major event for the company, something that was well disclosed. Seller said, yeah, he took unfortunate circumstances, obviously, but his company was receiving workers' comp. They're not going to sue. This is all said, done with. And we said, well, I don't know about that. We're still within the statute of limitations for a wrongful death suit. So that was an instance where we said, yeah, sellers, this was something that happened on your watch, in the event that something is going to come forward with this, whether it be, a review from OSHA or from, a suit from the family, that's, should be seller's responsibility. So those are material issues, especially when you get to a deal that doesn't have a huge transaction size. And that's why, making sure that people are looking out for those issues, especially towards the closing stage and negotiating appropriately, can really impact the ultimate value of a deal.
And all that to that, it all goes back to structure too, right? So, on a stock deal, if a buyer is buying stock, right, they're buying the business and all the skeletons in the closet, right? So, versus an asset deal where they're kind of handpicking, hey, here's the assets of the business that I want, and I'm leaving everything else behind, right? So the structure there, whether it's a stock deal or an asset deal, I think impacts, indemnification caps, escrow holdbacks, those types of things. You'll generally see higher amounts for stock deals versus asset deals.
Yeah, that's exactly right. I mean, asset deals in general do a good job of insulating a buyer from liability because they're only buying certain assets of the business, not the equity of the business as a whole. It's not perfect. There's, because anybody can sue anybody for anything. So then you get into the weeds of whether or not they're a successor. But it's a major consideration, especially at the LOI stage, that, and representing buyers. If you think, yeah, I like this business, but they seem kind of sketchy, that might be an instance where you want to go with an asset deal.
Excellent insight. And I'll pose this to David. What best practices have you seen for effective post-deal integration, and how would you ensure that the value of the acquisition is realized?
Yeah, I mean, I think it really boils down to making sure everybody's incentives are aligned, right? From a buyer's perspective, there's a little discomfort if they're buying a business and the business owner who's, founded the business, has all the customer relationships and all the intel and know-how of how the business operates. If that business owner is going to retire and ride off in the sunset, that's risk, right? So making sure incentives are aligned by, maybe as part of the consideration of the deal, offering some sort of rollover equity or earn-out or, bonus programs for the existing management team, right? I think that really promotes good post-transaction integration because the buyer has comfort that the seller is still, they still have some skin in the game and they're, directly tied economically to the future performance of the business.
Yeah, and I think the other thing from more of a business operational point and from a psychological point is, especially when you're involving PE, you're involving a whole host of additional players into a business. And very often you'll have an instance where you've got PE's buying a family-owned business. You'll have an owner who's 60 years old, has one, half foot out the door, but really is the dynamo behind that business, and the business is, his or her baby. And, that seller's acknowledging that they're getting out of the business, but you're bringing in, New York City, Chicago, wherever based firm, and you may have a, 25, 30-year-old who's, absolutely a whiz, works 20 hours a day, but hasn't been the boots on the ground for the business. And that's a weird dynamic to have somebody who's, all of a sudden, if you're that guy or gal in the PE firm in New York, you're the boss of somebody who's twice your age and has owned this business for their entire life. I think acknowledging that that's the dynamic and coming into it without any kind of misconceptions, and being honest and forthright and, clearly communicating is the way to really make the relationship work.
Excellent. And, from the seat of the portfolio company, I think that what's important is really having partners that understand the business. In our space, it's very complex, dealing with payroll, workers' comp, HR, compliance, legal, making sure that they understand what we're doing is very helpful to make sure that it goes through properly. From a market and trends and dynamics perspective, regarding current market conditions, how would you describe the current private equity market, and what are the main factors influencing deal flow and valuations today? And I'll pose it to both of you, if you don't mind.
Yeah, so I'll start and talk about M&A. I think we're seeing as a whole. So especially since 2020, there's a ton of money out there, and that money I think is in the market for good. It's the reason why your box of Cheerios costs twice as much as it did 3 years ago. It's why everything's more expensive, and the advantage that PE has is that when a lot of funds are based off of the commitments they're getting from the sovereign wealth fund of Liechtenstein and the payroll or the teachers pension fund in Michigan. Those people have real cash that they can put into a platform that's going to be able to build up and do acquisitions. So there's a lot of dry powder. There's in transactions, rather than having PE be a player, I think we see PE-backed buyers more often than not. And that's also due to interest rates, because non-PE-backed buyers, if you're a publicly traded company, you got to go to the debt markets. And what's going on in the debt markets? I mean, things have gotten better over the past couple of weeks, but it's a lot more expensive to borrow money than it was. So, broad trends from our perspective, M&A is still going well and strong, and PE-backed buyers are frankly the norm.
I would agree with everything Jon said. As far as volatility and valuations and market multiples, right? I mean, when it comes to the lower middle market, your traditional manufacturing, distribution, professional service firms, the market multiples haven't been too volatile, even with increased interest rates. We did see a little bit of compression on valuations based on it's going up and difficulties with financing, but there's no shortage of deals, right? I mean, these businesses that are founder owned, baby boomer owned businesses that are seeking an exit in the next couple of years. I mean, they're everywhere, especially in upstate New York with the dynamic of the landscape of the manufacturing, distribution, and professional service firms.
Jon, from a sector specific trend perspective, which sectors are seeing the most activity and why? And are there any emerging sectors that people here should look out for?
Yeah, it's a perfect for what you just said, Dave, because where we're seeing a lot of activity is service-based, family-owned companies selling in upstate. So this is your building supplies, HVAC, folks that may not have been the most exciting acquisition targets before, because they're not necessarily high-growth tech businesses, but they're in industries where, frankly, the refrain that you've heard for 20 years now is not enough people go to trade school. And a lot of these businesses have been feeling that crunch on talent for years, and now ownership is coming up to a point where they're already in retirement age. So if they're not seeing as strong a class of people behind them, they're sell. And combine that with a ton of dry powder available at the PE side, that's a recipe for a lot of activity in that space.
Yeah, tying that into how does that impact valuations, right? From a buyer's perspective, right? Recurring revenue is always a key driver, right? Does a business have contracted subscriptions or service agreements, recurring maintenance type contracts, right? Those, knowing that you have recurring revenue in the bank, will increase comfort from a buyer's perspective and ultimately increase valuations. Strong management team is certainly an important focus that impacts valuations, right? Has the founder, has the business owner done a good job over the past few years, right? Kind of stepping out of the day-to-day and grooming that next generation. Because again, from a potential buyer's perspective, in particularly PE buyers, right? They want to make sure that there's a strong core in place that can kind of continue running the day-to-day post-transaction. So having the right people in place, having comfort with customers, good quality reputation in the marketplace. I think those are big things that are focused by buyers and impact valuations.
Yeah, the good thing with this space in particular is, if you have a downturn in the market, somebody's HVAC system is still going to break. Somebody's still going to need to do construction. So a lot of these industries are more resilient when it comes to a recession. And granted, knock on wood, we're not in a recession and don't have, the economy is still strong, but it's weird. And 2020 was weird, and people are still making sense as to what the world is going to look like post 2020 with all the changes that happened there.
From an investor relations perspective, a PE fund and a PE-backed company is going to have many stakeholders involving fund investors, fund managers, platform companies, leaders, co-investors, et cetera. Can you discuss some insight on those interpersonal relationships that make businesses in the space tick, whether positive or negative?
Yeah, so this is kind of exactly what I was talking about before. I mean, there are dynamics in the space that are weird, especially when you have a founder who's, sold his baby and, he or she has one foot out the door. And now you're inviting new capital into the business. So having clear communications, clear expectations, alignment of incentives is something that we see a lot. I mean, talking about PE structures, I think, I wouldn't say more often than not, but close to it, you'll see a rollover of a seller to help align incentives. So aligning incentives, having that clear line of communication, and being professional. I mean, there's nothing more awkward than talking about an indemnification claim when you have people that were involved in a business that may have made a decision pre-acquisition that's resulting in a loss where you're considering indemnification. And, that's a minefield. But being professional, being deliberate in how you're communicating, and, just being as open as you can be is the best way to enhance communications.
Yeah, I think, Michael, you made a good point, about your specific experience, right? Your PE buyers understood the business, right? So partnering with people that understand the business, Jon said, frequent communication, transparency, financial reporting is a big thing, right? Making sure company's financial reporting is timely, is organized, isn't just a set of financial statements, but a good package of, KPIs and other meaningful things that PE owners or the board are going to look at, right? So making sure everything makes sense from a financial performance standpoint. So, the powers that be can make appropriate decisions on a go-forward basis. I mean, I think all of that stuff is...
Yeah, a lot of this really goes to interpersonal relationships that, an HR professional might be able to theoretically speak best to. I mean, it's, don't be a turkey. That's like a lot of those soft skills are just really important to making sure that you have an effective organization. And there's some framework that you can put in there, especially at the outset, that will help people work together better, like doing a rollover to align incentives, having, an employment arrangements in place that have a clear, term so that you have clear expectations as to how a transition is going to work. But a lot of it's just, playing nice in the sandbox and having clear communications and going from there.
Couldn't agree more. I think that highly structured deals are very important communication. In our world, there's a lot of lifestyle PEOs where the organization did really well. And, the founder was very happy with where it was at. And when a new organization comes in and tries to grow it, making sure that the communication is not hurting anybody's feelings. I don't know how else to say it. But it's not that they were doing something wrong. It's just that things are going to be a little bit different from a growth perspective. And this will be the final question. So from a career development and skill set perspective, what skills are crucial for emerging professionals in the PE space, and how can they develop these skills effectively?
Yeah, so a lot of it is the past couple of points I've been talking about is being a clear communicator. It's, be working well with people. It's understanding businesses. It's, when you're talking about networking, being consistent and targeted and patient. It's also being flexible and being willing to potentially go out of your comfort zone if needed, because you're working with a lot of other people and you need to deal with the interpersonal, dynamics as they come. I've got a soon-to-be 3-year-old and a 7-month-old, and, just based on what I do, it's hard to have a consistent schedule because the demands of the job change every day. And so a lot of what I got to do at the home front is clearly communicating about expectations with my wife about what we're going to do with the boys and, that sort of thing. So, a lot of soft skills, but nothing that's, I think, is rocket science by any means.
Yeah, the only thing I'd add to that, from a new analyst perspective, whether they're with an investment banking practice or whether they're with a PE firm itself, right? Analytical skills is super important, right? You got to be able to dive into the detail, put together financial models, leverage AI where you can, right? So, aside from the business development and the interpersonal stuff, there is a component of, analytical skills, and being able to also see that big picture while diving into the weeds, I think is something, super important to focus on.
Yeah, and on a legal side, I mean, we try to push as many numbers as we can off to the Dave and team, but being detail oriented, being flexible, is also just critically important. I mean, you actually need to be thorough when you're reading a contract. You got to read it. You got to be willing to, suck up those late nights when there's just a lot of stuff that needs to be done, and acknowledge that that's going to happen. But if you're willing to be flexible and be detail oriented and be a sponge, you can make it work.
Excellent. David and John, thank you so much. Appreciate it.
Great job. Excellent insight.